engaged in your research with Professor Tim Congdon, Professor Wood, myself, and many other colleagues in backyard. But perhaps we can move on and talk a little bit more about the sort of topics we will be covering in our modules. If you want to start, Tim, with yours.
Yeah, can I just say, I really do agree with what Jeffrey just said about history.
Yeah, please.
There is in economics this sort of split between those who believe in, I had this before when I came to the IA. I don't know why the IA caused this to my mobile phone, but there we are. I had lunch here with, and it couldn't stop going. Never mind, I'm sorry. Those who believe in mathematics as the answer to the world's problems, and those who believe in looking at how things developed, how people behaved, and historians, if you wish. I should just say I'm really an historian rather than a mathematician, although both have got their uses. In my course, it is about what's just going on today, but I'm going to start off with the invention of banking, the development of, well, the invention of money back in Greece and China, 800 BC, 700 BC, and then the development of commercial banking, and then why central banks came in. They came in not to regulate and control commercial banks, but to help commercial banks, and then to explain how money, the quantity of money is determined. Okay, money is essentially the deposit liabilities of banks, and then how that affects the economy. Okay, and again, just to sort of cut the long story short, there is a punchline in all this, which is that the Great Recession, like the Great Depression in America in the 1930s, was not caused by bankers' misdeeds. Bankers doing stupid things all the time. They're doing wicked things all the time. Okay. It was not caused by that. It was caused by a collapse in the rate of growth of the quantity of money, which was totally avoidable. All right.
Jeffrey, do you want to add something?
Well, I think I could possibly develop that. One, people speak of the inherent instability of fractional reserve banking, banks which hold a certain amount only of the money deposited with them and lend out the rest. This appears to be a very fragile system because, of course, if all your customers, or a substantial proportion of them, come at once, the money vanishes. And economists worry about that. I reviewed for central banking a very interesting and subtle book by a professor of industrial economics elaborating this point. But they have forgotten that when you think about these institutions, you have to think about the system in which they're embedded. And an analogy, I think, is helpful. Think of a bicycle. If someone's trying to balance on a bicycle, just while standing still, the bicycle is really rather unstable, because the bicycle is designed to be moving forwards. Then it becomes stable. What about banks? Banks are designed to be in a system and to function in a system where there is a central bank. Central banks developed at the same time as banking, and they learn very rapidly. The Bank of England was the first to learn to carry out what is called a lender of last resort operation. This should be sharply distinguished from bailing out a bank. It simply consists of lending liquidity, cash to them, in return for security, if their customers are demanding more than they actually have. The purpose of this is to allow, and this is something else modern central bankers tend to have forgotten, and economists, the purpose of this is to allow badly designed banks to fail, but containing this failure so that it doesn't bring down the entire banking system. That tended to happen in the United States at the start of the Great Depression, and it happened, as I implied earlier, for reasons internal to the Federal